All right, good morning. Welcome to a special edition of True Options Masters. Wanted to get one of our experts here on camera because he threw a bit of a Molotov cocktail into the mix yesterday. Well, it started last week. So I wanted to get him on camera and rough him up a little bit. No, I'm just kidding. I do want to get I wanted to talk to you one-on-one about this stuff, Mike. So during our monthly market outlook, which we do on video every first Wednesday of the month, you said something new that I haven't heard from you before. You said that you are seeing signs that we could be entering an exponential move in the market, a blow off top, sometimes also referred to as a melt up. And yesterday in True Options Masters, you recorded, you wrote an update about a short-term target and a longer-term target. So I want to get some of these numbers out from you, Mike. You said you've got basically short to medium term, 6 to 9 months, and then also something all the way out to 2024. So why don't you just give us a little bit of this context, Mike?
Sure. So let's go with the long-term target, and I'm going to be conservative here, but the long-term target for the S&P 500 is above 11,140. And that's 2024 target. So that's a potential gain of 147% in the next 3 years, an average annual return of 35% a year. And that's on the index. Individual stock, it's going to be like 1998, 1999, where we had tremendous moves in a lot of individual stocks, while other stocks just didn't go anywhere. If you recall, 96 to 2000, Warren Buffett had one of the worst performances of his career. Barron's was covering annually how the master has lost his touch. The market was roaring higher, Buffett stocks were not. And that's what we're heading towards. We're going to have a narrow market, we're going to have a rotational market, but we have a lot of upside potential.
That's a huge move, Mike. So there are two things I kind of want to ask you. And one is what's going to drive this move. And the second is, historically, what are some examples of this we've seen in the stock market? And perhaps maybe some other bubbles and assets in history. So let's start with the first question. What is going to be driving this move? Because this just sounds crazy. This sounds maybe even crazier than the 90s. I could be mistaken. Maybe it's about the same.
Yeah, it is insane, but there's a couple of factors that drive it. As subscribers who have been following market intel reports every Monday know, I watch the money supply closely because the money supply, the Federal Reserve's policy, does have an impact on the stock market. Recently in June, a paper was published by a group of academics, and it was one of those life-changing papers that, I'm sure, Chris, that you stay up nights reading the latest academic research.
Of course.
Just wondering which one is going to change your life. And this one tracked market price changes and correlated them to money flows. And that was just brilliant. Now, it's not easy to do. There's a lot of potential sources of money flow. So I've spent since I read the paper about 2 months ago, I've been tracking money flows from household financial balance sheets, stock market. And I've been able to develop some models, some formulas that describe those flows. And that's what helped me get these targets. A great analogy is 1996 to 2000. In December 1996, Alan Greenspan famously said, the market is irrationally exuberant. And he was right. The market was overvalued in 1996, but it went up. The NASDAQ went up over 300% after it was already a bubble. And that's where we are now. The Fed is adding money. Households are moving money. The Robinhood phenomena, it's small investors adding billions of dollars to the stock market through Robinhood. That's affecting the indexes. If they're trading options, market makers are still trading the stocks. So we are seeing that money push stock indexes higher. And we are seeing individual stocks dramatically outperform the indexes. Another, right before 1987, when the 1987 crash occurred, the market had bubbled up in the year prior to that. And a big factor there was the Fed adding to the money supply. It ended when the Fed reversed course, but the Fed isn't about to reverse course here. Powell wants to be reappointed, so he's not going to change course in the short term. He's then going to be focused on the elections in 2022 and 2024. So he's really painted himself into a corner, and it's an increasingly small corner. He's going to be standing in the corner watching inflation and stocks just rip higher, powerless to stop it. Unlike Greenspan, who really did try to stop the stock market.
Okay, so there's a lot to unpack here. So we've got the Fed angle, and we've also got the money flow angle. So you're saying that a huge amount of money is coming from households.
Right. That's actually the driver that we've been overlooking in most Wall Street models. We've always looked at cash flows. Institutional has more money dollar-wise than households. But the institutions get their money from the households. That was the missing link this paper put together. If you have a job with a pension, the pension manager is investing the money. We count that as institutional, but it's actually money that came from the household. Every dollar in the market is tied to a household. The Gates Foundation is the Gates household donating money to those managers. So it eases the analysis quite a bit. And a couple of years ago at the Total Wealth Symposium, I presented a model that showed sentiment is the biggest driver of the stock market. And I've been trying to unpack that research to identify where sentiment comes from. Instead, I should have been looking at how to just quantify what sentiment does. And that's what this paper did. That's why I was able to get really far along in my over just 2 months.
Yeah, so sentiment is interesting. And you talked about this, I think, a little bit in the article yesterday, that fundamentals are one thing, sentiment is another thing. And fundamentals are a little bit all over the place. You know, I feel like I haven't really seen people talk about the debt in a few years, but it hasn't gone away. It's only gotten worse. And eventually that bubble has to pop, right? But who's to say when that will happen, particularly if sentiment, bullish sentiment is the driving force in the market. I think I read recently, there was a period of 5 months in the past year or so where I think more money entered the market than the last 12 years or something like that. Right. You see stuff like that, and yeah, it's kind of impossible to fight that trend. But what are some of the other fundamental forces out there that could be fighting this, and that could, be potential black swans that are out there, or even just short-term drivers of selling? Because obviously we know when stuff goes up, stuff doesn't go up in a straight line. And in fact, when stuff moves exponential, like you're talking about, it actually can create several panic opportunities. Like 1997, 1998, we saw very, very aggressive sell-offs in the S&P 500 and the NASDAQ especially. What are some other things we need to be on the lookout for?
1998 was a great example of that black swan. There was a currency devaluation in Thailand that spread to Malaysia and then other Asian countries. Nobody was watching Thailand, but that impacted a hedge fund that had cornered the market for Danish mortgage bonds. Accidentally, they owned almost all of the bonds backed by mortgages in Denmark. You can't predict that. Obviously, the fund didn't predict it. The global financial system almost collapsed in 1998 because of that. So that's the kind of black swan that's out there. There's a hedge fund that's over leveraged. We don't know about it yet. There's states, Illinois comes to mind, that are having trouble paying their bills. We're going to have to restructure that. The question is how. And we're seeing a lot of money go into municipal bonds because municipal bonds are starting to reflect the risk of default. So if there is a default at a state or large city or county, we're likely to see a panic selling, and panic selling is never restricted to one asset. So we're also seeing cryptocurrency as a potential black swan. Institutional investors are getting more and more involved in crypto. As they do, they're cross-leveraging their investments. When you cross-leverage, you create risk in other markets. So let's say crypto were to fall 20% in one day. We know that's possible. We've seen it.
It happened a couple days ago.
This year, yeah. And that was the second time. It happened in March also. Every 6 months, we may see a crash in crypto. That's okay when the market is in crypto. But when you have a large hedge fund that is leveraged in crypto and leveraged in stocks, you get a 20% decline, they're going to have to meet margin calls somewhere. They're going to sell what's liquid. They're going to sell stocks to raise cash. So these are the kind of black swans that are out there. Given the status of sentiment, given the fact that sentiment drives cash flows to the stock market, black swans are going to be buying opportunities probably until 2024, when the election adds a degree of uncertainty that we haven't seen in quite a while.
Yeah, and cryptocurrency, right now, the market's worth what, $2-3 trillion, a fraction the size of the US stock market. But if this thing keeps growing at the rate that it is, when it's worth 10, 15, 20 trillion, 10, 15, 20% sell-offs are going to be a lot more severe. And that kind of selling action is going to ripple across the other market, especially if what you're saying is true. And there's this sort of relationship between the way that they have allocated and are leveraged in other areas.
Okay, well, the Danish mortgage market is very small, and it was even smaller in 1998. And it brought down long-term capital, and it took the global financial system to the brink of disaster. It required Greenspan to convene a meeting, tell the investment bankers on Wall Street, you are going to bail this thing out right now. And they all stood up and did it, except for Bear Stearns. And 10 years later, when Bear Stearns was in trouble, everybody on Wall Street has a long memory. Nobody stepped in to help them because they hadn't helped out in the last crisis. So these kind of things are lurking out there. And small markets are where the biggest black swans dwell.
Makes sense. So let me ask you, Mike, what's the best way for us as true options masters to take advantage of this? I can imagine one solution might be to look at strategies, use historical analysis to look at 1996 to 2000, look at some strategies that worked really well during that period. That might be a lot more useful even than looking at strategies from the last 10 years. I know when we backtest a lot of our strategies, we typically do about a decade, maybe 2 decades. But in this case, it might be really useful to look back 1996 to 2000.
Correct. We want to find the strategies that work in the blow off top phase. And we want to ignore the rest of the data for now. It's going to be setbacks, but we want to be very aggressive. We want to focus on the stocks that have the highest velocity, the peak velocity, if you will. And we want to buy options on those to leverage our investment potential. And we want to stick with call options because the puts are going to be erratic at best. In this environment, we're just going to see calls roar higher, puts decay to zero. And that's the basic strategy for the next 3 years.
Okay. Yeah, I agree with you. Puts, I personal experience, I found puts to be a lot more challenging to trade than calls. So are there any particular sectors or particular groups of stocks that we want to be looking at? Let's just narrow this down a little bit further. So we've got this idea. Maybe we look back at historical analysis, 96 to 2000. What else can we do? I mean, 146% in the S&P 500 sounds great. But I imagine we'll probably see even more bullish activity, perhaps the Russell 2000, probably the NASDAQ again. I mean, the NASDAQ's been leading the market the last several years.
Right. We're going to see a rotation during the next 3 years. Right now, tech stocks caught everyone's imagination, but small caps have been in a consolidation almost all year. They're near a breakout, and they should just roar higher. And that's just going to be rotational sector to sector. Infrastructure is going to have its day in the sun. Airlines are coming back, hospitality. We're just going to see money flow based on sentiment. And Robinhood used to publish data showing where their traders were. Those were the hottest sectors in the market. Now we hear about the meme stock and we learn about it that way. That's basically what we've got to watch. It's just which sector is seeing money inflows, and that's where.
I agree with you on the Russell 2000. Obviously, we saw a huge breakout in those stocks last year after, again, years of consolidation. And I look at that chart almost every week, and it's just been in this narrow range, up and down, up and down. I've literally, I buy calls when it's down here. I buy puts when it's up here.
Right.
And I'm probably going to continue doing that until it breaks out of that trend. But I do agree with you. We'll probably see another breakout in those stocks. And you mentioned, or you referred to the coronavirus. You know, obviously we're kind of seeing this second wave and this Delta again. But I mean, I can only imagine that, you know, this stuff's not going to last forever. It never does. And you know, imagine when, I mean, the economy doesn't have to worry about this anymore. Irrational exuberance. I mean, talk about irrational exuberance. I mean, if we think about activity in the stock market's been, you know, very, very tremendous while the coronavirus has been raging. I can only imagine it's going to be go even faster after we get through this.
I think you're right. RV sales are at record highs. People are using their stored up money to buy experiences for the future. Sales at sporting goods stores, music stores, hobby shops, also at record highs, tremendous growth. Sporting goods, hobby shops, 13.6% year over year growth in the latest retail sales data. So people are buying that equipment, planning to use it. Delta's kind of put a damper on their plans, but RVs hit the road as soon as it's safe. People are prepared to go out to the park. And after they use their sporting goods, they're going to want to go to restaurants and bars. They're going to want to buy additional stuff to make their sporting life better. There's a lot of pent up demand in these purchases, and it's going to explode higher when they can actually enjoy it.
So I think, just to recap, we're looking at a blow off top stock market that could send the S&P 500 to, what was your target again? 11,000?
11,150 by 2024, potentially a 36% gain in the next 6 to 9 months based on cash flows into the market.
Okay. So over the next 6 to 9 months, we'll see it top over 6,000. And the best ways to play this, watch sector rotation. Tech stocks have been moving higher. Pretty soon, we'll probably see a breakout in the Russell 2000. Just keep an eye on those charts. Eventually, we're going to see airlines recover after a coronavirus moves on and that story is over. And then also keep an eye out for black swans. You know, there is a lot of risks that are out there. And as markets move exponentially higher, there are going to be periods where Wall Street wants to take profits. It's going to aggravate selling, and those are going to be buying opportunities. Is that pretty much a good summary, Mike?
That's a good summary. I'm bearish by nature, but we have to overlook that. This is going to end really, really badly. But we have a tremendous push higher before it gets really bad. And that's where we need to be to benefit.
I saw this happen all last decade of people. You know, the financial crisis really affected people's psychology. And I think it still is to this day. How many bears there were last decade? People just every day saying, oh, we're going to see another crash again. There's no way we're out of the woods. You know, the fundamentals haven't changed. And all those people missed out on one of the greatest decades in stock market history. And you can look at that and realize, yeah, like stuff doesn't have to make sense for you to make money. But I appreciate having you to help us, make as best sense of it as we can. And I also appreciate you recognizing your own personal bearish disposition. You're a realist, Mike. You're a logical thinker, and you see all the problems that are out there. And yes, by any stretch of the imagination, logically, these things should be putting, a ceiling on the stock market, but that's not how these things work. Human greed gets the best of us. Sentiment is much more important than fundamentals right now. And I agree with you. I think that we're going to have some amazing opportunities to make money. And it encourages me to hear you say that, we've got a few years of this potentially.
I think we do. And if cash flows change, we'll be monitoring that, watching this model continuously, and we'll adapt. Maybe we'll be able to catch the next black swan, but it's going to be short term. We'll just ease up and really load up on the calls as the market falls.
Well, Mike, I look forward to subsequent updates from you on this. I think it's going to be an exciting story for years to come, and looking forward to hearing some of your future targets.
Great. Thank you, Chris.
All right. Thanks for talking. We'll chat later.